Hello, everyone. My name is Denise Chan Gans, and I am the Executive Director in the Office of Gift Planning at the University of Chicago. I'm pleased to welcome you today to our first virtual estate planning webinar. Before I introduce our speaker, I wanted to mention a few housekeeping matters. Today's program is a webinar, so that means that your camera and your microphone will be turned off. If you want to enable closed captioning, you can click on the CC at the bottom of your screen. We are going to leave some time for questions, so if you'd like to submit a question, we encourage you to do so throughout the presentation, and you can do that by using the Q&A button in the center of the bottom of your screen. We've had an incredible response to this webinar, and we're thrilled to know that University of Chicago alumni and friends are looking to us as a resource for this type of content. This program, though, should not be relied upon as legal or tax advice, but we do hope that it will be useful for you. As always, consult your own advisors for advice that's specific to you and your own tax situation. It is now my pleasure to introduce our speaker for today, Howard Helsinger. Howard is a graduate of the law school and a named partner in the law firm of Sugar, Felsenthal, Grace, and Helsinger, LLP. He lectures on multi-generational estate planning and tax planning, including teaching a private wealth management course offered by the Executive Education Program of the University of Chicago Booth School of Business. Howard has taught courses on trusts and estates at the university's law school, at Northwestern University's Pritzker School of Law, and in the graduate tax program at IIT Chicago Kent College of Law. Howard is a member of the American College of Trust and Estate Council, a past chair of the Chicago Bar Association Probate Practice Committee, and a frequent lecturer for the Illinois Institute of Continuing Legal Education and other state and local and national bar associations. He concentrates his practice in estate planning, administration, probate, charitable planning, and trust and estate related litigation. Howard has a BA in English from Haverford College, a PhD in English literature from Princeton University, and a JD from the University of Chicago Law School. He is married to Elizabeth Helsinger, Emeritus Professor of English and Art History at the University of Chicago and former chair of the Department of English and Department of Visual Arts. It is my pleasure now to welcome our speaker, Howard Helsinger.
It's my pleasure. Hello, everybody. It's a warmish day here for the first time in Chicago, and that's a delight. It might even be about to be spring. We'll see about that. We have a lot to cover, so let me try to get started here. First, let me just give a shout out to my friends in London and in Florence. You know who you are. I'm glad you're with us today. Where are we going? Well, I'm going to start by telling a story. I'm going to tell a true story about a long 2.5-hour conversation I had with a client of mine, in which I discovered that there was a fundamental missed planning opportunity in the documents that we had prepared for him. And that seemed like perhaps a useful lesson for everybody. Then we'll talk about some of the proposed tax changes that we've heard discussed and what kinds of responses might be appropriate now. And we'll conclude with a couple of suggestions of some current estate planning opportunities. To lay the basis for that, let me just lay out in quick outline the fundamentals of the estate and gift tax system. The estate tax is imposed on what you own, control, or have the full benefit of. Those are each somewhat technical terms, really, because precisely what ownership means, precisely what control means, precisely what the full benefit of means are narrowly and precisely defined. Each of us has an exemption from estate tax. That is, we can leave a certain amount free of estate tax to anybody at all. The federal exemption right now is $11.7 billion. If I don't use it all, it's available. The unused portion is available to my spouse along with her exemption, so that combined, a couple could leave $23.4 million estate tax exempt, free to their children or anybody. There are also 12 states which impose their own estate tax, and generally that is not portable, and that is state estate tax. It varies from state to state, from 1 million to 7.1 million. The average is around 3.8 million exempt. The goal, therefore, in estate planning, one goal is to make sure both spouses use the exemption which is available, at least the state, and if they have sufficient funds, the federal. The way both spouses might use those combined exemptions is to make sure that the first spouse's exemption winds up in a trust for the benefit of the surviving spouse, so that the surviving spouse is not going to be taxed on it. The spouse can have the benefit of that trust, but not be taxed as the owner of it. And therefore, the first exemption gets used at the first death, and the second exemption gets used at the second death. That's not an issue for the federal exemption because it's portable, but it would be an issue for the state exemption, which is not portable, as we'll see. Well, now you've just wondered, does my state have, well, let me continue for a moment, the other issues, which we'll come to. There is a gift tax exclusion. You can give $15,000 per donee to an unlimited number of donees this year. An example we dive into later will take advantage of that. You can also pay for whomever you choose their tuition at an educational institution and their medical expenses. And there is an unlimited marital deduction. You can leave any amount to a spouse tax-free. That way, one spouse dies, there need be no estate tax whatsoever. At the death of the first spouse, it all gets deferred to the second death. Now, as to does your state have an estate tax, there's a list of them. There's a map, and you can scan that quickly and determine whether your estate might be exposed. As to the details, it's best for you to check with your advisor. Now to go back to my story and my 2.5-hour conversation with my client, who had a wonderful set of estate planning documents because we'd prepared them. But this is the way his estate planning was arranged. He had, and this is a standard plan, and your plan probably either looks like this or should look like this. He had a simple will. The will was what we call a pour-over will. It said, give everything to my trust. He had then a series of assets in instruments which we call will substitutes. One was a revocable trust, which we sometimes call a living trust because you create it while you're alive, and it continues during your life, and continues revocable during your life. And that document contains all the provisions that you would expect to find in a will, specifying where assets are supposed to go. Fine. He also had a number of joint accounts, joint with his spouse. He had retirement plans, the beneficiary designation named his spouse. He had life insurance, which named his spouse as a beneficiary. All of that's reasonable. And he had powers of attorney, which are instruments in which he named an agent to act for him if he was unable to act for himself. You can have a power of attorney to allow somebody to handle your property if you cannot do so, and another power of attorney which names an agent to make healthcare decisions for you if you are unable to make them for yourself. As long as you can say, no, don't do that, the doctors will follow your directions, not your agents. That's a perfectly reasonable set of documents. But what are the consequences in that case? I hope you noticed that 3 of those items were in italics. He had joint tenancy accounts, all of which paid to his spouse. He had retirement plans, which paid all to his spouse. He had life insurance, which paid to his spouse. The result was everything he owned went to his spouse. Everything, therefore, would be included in her estate at her death. Everything, therefore, which he owned would be taxed at her death, except for her exemption, because remember, she had an exemption as well. Now, what I'm concerned about is the state exemption. His federal exemption would be available to her if he hadn't used it. The tax consequences for them, track this, please. His assets, his 4 million, I'm assuming that's what he had, went to his spouse. So she had his 4 million. She had her 4 million. She had a total of 8 million. The tax consequences were her estate would be 8 million, less her exemption of 4 million. The amount left subject to tax would be 4 million. And if they lived in Illinois, where the exemption amount is $4 million, her estate would be subject to a tax of $680,000. Not an attractive result, because it could have been avoided. What should he have done? He should have had some assets pass through his revocable trust. You'll notice that none of them did. All those arrows ran straight across the screen. His revocable trust provides that at his death, 2 trusts were to be created. One of which his wife would be the trustee. Both of them, she would be the beneficiary and the trustee. That's fine. But one of them would be an exempt trust, which would receive that $4 million exemption amount. That exempt trust would be designed, it was designed so it would not be taxed as part of her estate. The other trust, which would receive the amount over the exemption, if he had any over the exemption, would be included in her estate, but she could use her exemption to keep that exempt too. If that is what he had done, the documents attempted to do that, but if in fact he titled his assets properly, then the exemption amount would have gone into an exempt trust for his spouse and family and not be included in her estate. Other cash and stock he held would be go into a different trust for his spouse and family. His retirement plans would go to his spouse as they should. His life insurance would go to a trust for his spouse and family. That's fine. His estate of $4 million would go to a trust for her and use his exemption. Her estate would have his 4 million, but it would be in trust for her and not taxable, not included in her estate. Her 4 million of assets would use her exemption. They would be 0 tax. A savings of $680,000 in taxes. What's the exemption? The lesson from that? The lesson is that his estate would, or their estates would incur estate tax when they both died because he didn't take advantage of the provisions of his trust. The result was that his state exemption was lost. It was lost because his exemption wasn't portable, so it could be used by his spouse. Now you're wondering is why is any of this relevant to me because I'm not married or because I don't live in a state which has an estate tax? It might still be relevant because even if you're not married, even if your state doesn't impose an estate tax, your donee's estate may be subject to state or federal tax, and a trust created by you leaving their inheritance in trust for them might keep that inheritance out of taxes at their death. Enough of my story. I hope my client has taken care of that since. To continue and think about the current tax proposals on the table, they're income tax proposals. One of the income tax proposals is to raise the top income tax rate from 37% to 39.6%. And then on top of that, there's a net investment income tax of 3.8 for filers over $250,000, so that the maximum rate combined amounts to about 43.4%. You say, oh my God. Another proposal is to tax capital gains at ordinary income rates. Capital gains are now taxed at perhaps 20%, to tax them at that 39.6% rate. That proposal applies only, or is proposed, would apply only to households with gross income of over $1 million. So it exempts from that a whole lot of us. What, looking at these proposed changes, what, if anything, should you do now? My sense is carry on the way you've been acting thus far. Invest efficiently for tax purposes, netting gains against losses. Hold capital assets for long term so you don't incur short-term gains. If you have appreciated assets, consider donating them to charity because you'll get a deduction for the full value without recognizing the gain. Those are attractive options. If your income is more than $1 million, I suggest you talk to your financial advisors. There are also estate tax proposals being nosed about. One, the one we hear most of, is to eliminate a basis step up at death. What's that about? I have a client who purchased in 1991 $71,000 of Apple stock. He has never sold it. He still holds all of those shares. Would anyone like to guess how much those shares are worth today? $19 million. My client has a capital gain on those shares of a bit over $18 million, or a good bit over $18 million. If he sells all that Apple stock today, he'll recognize a capital gain and pay taxes of 20% on that entire gain. If he holds it until death, and this is the point, the way the tax code works now, the basis of all of those Apple shares is stepped up to their current value as of today. His family will receive all of those shares at that stepped up basis. The next day they can sell them all and there will be no capital gain realized at all. The proposal is to treat those inherited shares at his death as if they were still worth $71,000. That's his basis. The proposal would exempt $1 million of gain per individual. It would be portable between spouses, which means a couple would be able to exempt $2 million. And there's a separate exemption for gains on a house, which amounts to $500,000 for married couples. There are also family farms and family-owned businesses are treated separately. And there's a discussion. It's not clear that this exemption would apply, or a broader exemption would apply to gains on family farms and family businesses. It's worth stopping at this point and considering who benefits from this step up in basis. It is those who don't need to liquidate assets during their life to have cash to live on. A large proportion of the American population owns some stock, but it is not all of that population who can afford, after they've retired, to not sell some of it to have the cash to live on. And of course, those who inherit those shares with a stepped up basis and then or later sell them benefit from the step up in. Facing that possibility, which I remind you is only a possibility, it has been discussed. We all know that Congress is a bit of a meat grinder, and who knows what comes out of the meat grinder at the end of the day. But what might you do? Well, you might, given the possibility of a $1 million exemption, move $1 million of low basis assets into your estate so that at least that amount will take advantage of that exemption. What's that mean? Well, you might have a trust which would not be taxed, and you can exchange assets with it so that those low basis assets are in your estate. Or if one spouse is moribund, the one more likely to survive could give the low basis assets to the one who's most likely to die first. You could give $1 million of low basis assets to your elderly parent, not that you're hoping they're going to die, and you might get it back with a basis stepped up. You could move low basis assets out of your estate. You could use low basis assets for charitable gifts because you get a deduction at fair market value, and that deduction this year is available up to 100% of your adjusted gross income. What else might you do? You might, anticipating this, sell and trigger gains now or later and offset gains with losses. That's standard planning. You might, this is a more sophisticated option, sell now and trigger the gain. Pay tax now at the current capital gains rate. And then immediately repurchase the shares you just sold. So repurchase, that's not a wash sale because it's a gain, not a loss. What you will have done is reduced your estate by paying the tax at the current capital gains rate at a lower capital gains rate, and the beneficiaries that you'd have will have a higher basis because you stepped it up. This seems very clever. I will note that you will regret this if the step up is not eliminated and you will have paid a capital gains tax that you didn't need to pay too early. There are other proposals regarding the estate tax. One is to reduce the estate tax exemption from the current federal exemption from $1.7 million down to 5.5 or 3.5. It was scheduled to go back anyway in 2006. There's a lot of discussion about this among practitioners, but it's all, for the moment, remains conjectural. And the discussion is all about the concern that if you make a gift now, as we'll see, it's not a bad idea, of $1.7 million now to take advantage of the current exemption, and the exemption amount collapses back to some lower number, will that excess gift over the reduced exemption be dragged back into your estate? That's purely conjectural. In part, I think it's a lot of practitioners stirring the waters. The reduction, I'm told, would require 60 votes in the Senate and may be therefore unlikely. There's also a discussion of limiting annual exclusion gifts. Remember those $15,000 gifts you can give to any number of people. The proposal would limit it to $30,000 per donor and $1 million over life. Again, a proposal. There is a discussion of limiting valuation discounts, which are a very popular, very effective, very powerful estate planning tool, particularly discounts on the values of family limited partnerships. Another proposal. It's been on the table for a number of years. We will talk about grantor trusts. That those would be irrevocable trusts, which would not be included in your state under current law. The proposal would be to include them and tax them. And then there's another powerful tool called a grantor retained annuity trust, and the proposal is to limit or restrain the use of those. All of these are proposals, and we don't yet know what's likely to happen. What should you do now? What can you do now? You can use that current federal exemption if you have sufficient assets to do that. You could make direct gifts to children, or either outright or in trust. Ideally, gifts of appreciating assets, gifts of assets subject to a valuation discount. You could make a gift to an irrevocable grantor trust. You could, your spouse or a surviving spouse could make gifts from a trust which she'd inherited for her benefit to reduce her taxable estate. You could use gifts to fund an insurance trust so the trust could pay premiums. There are gifts you could make now to grandchildren to take advantage of the generation skipping tax exemption. I'm not talking about generation skipping, but if you know about it, that's another option. Before we go on, I would just note that there's a lot of discussion out there. I somewhat conservatively think that, well, it's a function of what the level of your anxiety is. If you're terribly anxious about these exposures, then perhaps you should do something to allay your anxiety. But it's not at all clear at this point what will get enacted. Now, move forward a moment to what some current opportunities are. And I'm going to illustrate the possibilities of a particular kind of charitable trust. You can create a charitable trust in two forms. One, a trust which says, pay a certain amount to charity for a number of years, and then after that number of years, give it to my family. Or you can do it the other way around, and the trust says, pay a certain amount to me or to my family for a number of years, and then give it to charity. That's called a charitable remainder trust. A charitable lead trust is particularly attractive because right now, discount rates for determining present value are historically low. I've never seen them so low. Right now, the discount rate for May is 1.2%. We could still use the rate for March, which was 0.8%. What that means is we're going to pay a certain amount to charity each year for a number of years. The value of what I'm giving to charity is discounted at that rate. It's hardly being discounted at all to get to present value. So that low discount rate yields a much higher present value of my gift to charity, and therefore a higher charitable deduction. That's an attractive option. if I create a trust for 20 years to pay 5% of that $1 million trust, so it's going to pay $50,000 a year to charity for 20 years, my charitable deduction today will be $920,000, almost the entire amount. If I'm a 74-year-old, I can create a trust for my life, measured on my life expectancy, same 5% payout, measured on my life expectancy, the deduction would be $538,000. Those are attractive options, I think. Another option is to make what's called a qualified charitable distribution from your retirement plan directly to charity from your IRA. Minimum $100,000, you can direct the plan to make that distribution. It will reduce your required minimum distribution from your plan. I'm assuming you're already taking required minimum distributions. You're over 72. Therefore, that distribution reduces your adjusted gross income because you haven't taken it into income as required minimum distribution. It will lower your income tax bracket, or may, depending upon where you are within the bracket. That qualified charitable distribution must be paid to charity, not to a private foundation or to a donor advised fund. And you must arrange to have that done before you take in that year any of your required minimum distribution. Now, we've also heard a lot about changes to retirement accounts. And those changes, have taken away a notable opportunity, and estate planners lament the loss of that opportunity. Children and grandchildren, and this now is in effect, can no longer receive required minimum distributions based on their age. It was a lovely opportunity to leave my retirement plan to my spouse and then to my grandchildren, so that a 4-year-old would start taking distributions at minuscule amounts that would might last for his entire life. That loss of a stretch IRA, we've lost it. Now, that required minimum distribution has to come out of the life expectancy, or can come out over life expectancy, only for individuals who are the owner's spouse or a child while that child's a minor or disabled, or if the beneficiary is younger than the plan owner by fewer than 10 years. A nephew of roughly the same age. And the RMD must come out each year, beginning at 72. For all the other beneficiaries, which would include adult children, the distribution has to come out over 10 years, and the required minimum distribution comes out each year. Now, I would just remind us, as we lament about this change and this loss of a powerful estate planning opportunity, that ERISA, which established the laws regarding retirement plans, was never intended to create inherited wealth for children and grandchildren. It was intended to fund retirement for the plan owner. And this really is a recognition that that's the primary intent. It's only those of us who've been fortunate enough to build multi-million-dollar retirement plans who even were able to take advantage of that stretch IRA. What nonetheless might you do? You might make a gift of a small IRA directly and just not worry about the stretch. There is elaborate discussion of using your IRA account to fund a charitable remainder trust, which would pay out a specific dollar amount each year to beneficiaries as a way of mimicking a stretch IRA. That discussion is very complicated, and the calculation of whether it's really going to pay makes it, to my mind, uncertain. One last possibility here, and this is a very simple one. This what I'm going to suggest is something that we could do all along. But the idea is to use a grantor trust. What's a grantor trust? It is a trust of which you are the grantor, the creator. You're taxed on its income. Seems strange? Maybe. But the advantage is the trust grows income tax free because you're paying the taxes. Your payment of the tax, however, which is the tax on the trust's income, is not treated as a gift by you to the trust. It isn't, because it's your legal obligation. That trust could be irrevocable and therefore not taxable in your estate. That's the fundamentals of a grantor trust. How do we take advantage of it? With a little tax planning jujitsu. I suggest we use the tax planning strategies that remain available and will remain available, it seems, at least for the moment. Let's use annual exclusion glyphs. Yes, let's use valuation discounts. Let's take advantage of grantor trusts. And at the same time, we're taking advantage to a degree of the fact that there are going to be higher income rates, or maybe. What's the proposal? Make annual exclusion gifts to grantor trusts for the benefit of your descendants. Create one for each of your grandchildren. Give $15,000 a year to each of those trusts. You and your spouse can give $30,000 to each of those trusts. The husband and wife can give $30,000 a year to a trust for a grandchild. There'll be annual exclusion gifts. I'm going to assume that the assets in that trust grow at 10% a year, and that's all taxable income. And you are paying the tax on that. Without grumbling, please. At the end of 2 years, there's the original $60,000 plus $1,800 of untaxed income in that trust. It's not in your estate because it's an irrevocable trust. There's almost $26,000 more in that trust than if you had not made those gifts, if it had been included in your estate and subject to estate tax in your estate. After 10 years of doing that, that's $240,000 more that you will have gotten to your family. If you were making gifts with assets discounted at 40%, and I've not talked about how assets might have discounted value, but if you were, that would be over $400,000 more available to your family than if you had not made those gifts. And I'm talking now only about one trust for one grandchild. You have 6 grandchildren, create 6 of them. Those are just the assumptions I was working with. What have we gone through then at this point? First, I think we suggested don't waste the estate tax exemptions, the federal exemption and the state exemption. Use a trust. Make sure that your assets are held in a fashion they are titled so that at least some pass through your revocable trust, and use the magic language that your attorney drafted there for you. Pay attention to the basis of securities. You should have been doing that all along. The tax proposals on the table simply alert you to that much more vividly at this point. And finally, take advantage now of the gifting opportunities which are available: charitable gifting, annual exclusion gifts, and if you're willing to accept the risk of a change being retroactive, the results of which I'm not sure are altogether terrible, the making gifts up to the extent of the current federal exemption. That's all I have to say. Have a good afternoon. Thank you all.
Thank you so much, Howard, for all of that useful information on both basics of estate planning and also your take on some of the current developments and decision points in the planning process. So I'm going to proceed with some questions. We had a lot of questions pre-submitted before the webinar today, and we have some good ones that have come in through the Q&A box. So, you know, you gave us a sense of sort of the changes that might be upon us, but also commented that it's very hard to plan right now without really knowing what will be passed into law. And maybe it is a little bit premature to go ahead and overhaul your documents at this point. But a lot of people are thinking about their plans, reviewing their plans. What are some updates that you might recommend that aren't necessarily tied to tax planning, but just general things that people should be paying attention to as they review their documents?
Some are in effect the things we've talked about already, because you should make sure that you are able to use your federal or state estate tax exemption, and perhaps, if you choose, take advantage of it before it possibly gets reduced. Certainly, because it is such a powerful tool, you can move ahead, continue to move ahead, making gifts, annual exclusion gifts to trusts for children, for example. There are a couple of items that I notice increasingly that all of us probably have forgotten about or may have forgotten about and ought to give some thought to. Your digital assets. What are you going to do with those? What's going to happen? Do you know? Start with the simple question. And I tell you that there are abundant, a terrible number of my clients are keeping all their passwords on little scraps of paper that is someplace on their desk. And when they're gone, their spouse or their children won't know which password goes with which account, and won't know how to get into any of those accounts, or figure out which assets, which bills are being paid automatically online, and stop that, and so on. There are ways, there's an efficient way of doing this. You know, I understand this doesn't sound to you like estate planning. It actually is, because what that really amounts to is, how do you make sure that your assets are received by your heirs in the best possible manner? There are available a number of very fine, what are called password safes. One that comes to mind, it's not an advertisement, it's called LastPass. I use one called KeePass. I think I must have 256 or 300 different passwords. I don't remember any of them. All of those are available in a file on every computer I use, my laptop, my phone, this desktop. And there is a master password which gets me into that. My son knows what that master password is, so when I'm gone, he can access it all. And otherwise, I can assure you, it is extremely difficult to get all, to even access all of those, because whether it's Facebook or anything else, they will have restrictions which may make it very difficult for anybody else to get in. The one other thing that you need to do, and this should be in your documents should specify that your executor or your agent under your power of attorney has the power to access all of those things. And if your documents are even relatively recent, but not within the past several years, they probably don't say that. So you might want to go back and talk to your attorney about getting a provision like that into your documents. The only
Thank you,
other,
Howard.
well,
That's a great tip. Just to realize that there's a provision that could be added to give a trustee or an executor authority.
ours goes on for almost a page, I think. But yes,
Lawyers like to do that, I think so.
I'm afraid so.
Wordy. Let me move on to another question that came in through the chat. One of our attendees said, I have always been told that one can only deduct charitable gifts of appreciated securities up to 30% of your AGI. I believe I heard that charitable gifts can be deducted up to 100% of AGI. So is there a change this year? Is there something special this year?
The deduction up to 100% of AGI is correct. You'll correct me if I'm wrong, Denise.
For cash.
Right. That's where I was going, because the 30% limit relates to the identity of the asset that's being contributed. And there are also limits with respect to the identity of the recipient. So the limit, and Denise, you do this every day. I don't. The deduction for cash was, as I recall, 50%. Is that correct?
Most recently, it was 60%.
60%. Thank you. Tell you how long I've been practicing. So I think that's the distinction that question is asking about, and which needs to be distinguished.
Correct. And I will just volunteer that it was true last year, this 100% AGI deduction for gifts of cash, and they extended it to 2021. So it is an opportunity for individuals who do want to maximize that deduction this year.
But that's a deduction of cash.
For gifts of cash, correct.
Right.
We are near the end of the hour. So I just want to thank you, Howard, for taking the time to share your expertise with our constituents today. And if we didn't get to your question, either in advance of the presentation or in the chat, please contact us. And if you'd like to continue the conversation, we're happy to do so. You can email us at giftplan@uchicago.edu. We are putting that in the chat as well for your convenience. As those of you who have worked with us know, we are willing and able to have broad-ranging conversations about giving techniques, priorities, gift assets, and areas of support at the university. So we welcome you to reach out to us at giftplan@uchicago.edu. Please be on the lookout next week for an email with the link to the recording, and thank you for your patience with some of our technical issues. The email will include a short survey, and we would really welcome your honest feedback and ideas for future webinars. We had a very fantastic response to this webinar, so we absolutely intend to do more of these and really take your feedback to heart. I will conclude by saying that our goal is to be a relevant and useful resource to alumni and friends, and our mission is ultimately to maximize your giving to the university. So thank you very much for attending our first virtual webinar, and have a wonderful rest of the day.